There's a trade happening right now that doesn't make sense. Gold just hit an all-time high. Silver is moving in ways it hasn't moved in decades. Copper inventories are collapsing. And yet, the financial media is calling it a bubble. They're warning retail investors to stay away. They're saying commodities are overheated, but here's what they're not telling you. The reason these prices are rising isn't speculation. It's not retail mania. It's not even inflation in the way most people understand it. It's something far more structural. The paper market, the system that has priced commodities for over 50 years, is starting to break, and almost no one sees it yet. Let me explain what that means. When you hear the price of gold or oil or copper, you're not hearing the price of the physical metal or barrel. You're hearing the price of a contract, a promise, a piece of paper that says someone will deliver that commodity at a future date. These contracts trade on exchanges like the COMEX, the LME, the NYMEX. And for decades, this system worked. It allowed producers to hedge. It allowed speculators to provide liquidity. It allowed banks to financialize resources and make them tradable like stocks. But there was always one assumption baked into the system, the assumption that physical delivery would remain rare, that most contracts would be settled in cash, that the paper price and the physical price would stay synchronized because no one would actually ask for the metal. That assumption is now being tested, and it's failing. Here's the issue. The paper market allows you to sell something you don't have. You can sell 100 contracts for gold without owning a single ounce. You can sell 1,000 barrels of oil without controlling a single well. This is called naked short selling in commodities, and it's completely legal. In fact, it's encouraged because it creates liquidity, it smooths out volatility, it keeps prices stable, but it only works if the system remains balanced. If the number of people asking for physical delivery stays low, if trust in the paper system stays high, if the exchanges have enough physical inventory to cover the small percentage of contracts that actually demand settlement. Right now, all three of those conditions are deteriorating simultaneously. Start with gold. The COMEX is the primary exchange where gold futures are traded. At any given time, there are hundreds of thousands of contracts open. Each contract represents 100 ounces of gold. So if there are 300,000 open contracts, that's 30 million ounces of paper gold being traded. But here's the problem. The COMEX only has about 20 million ounces of registered gold. Registered means it's available for delivery. The rest is eligible, which means it's stored in the vault but not earmarked for contracts. So on paper, the COMEX is already leveraged. There's more paper gold than physical gold available to deliver. Now, this isn't new. The COMEX has operated with leverage for years, but it only works because most traders roll their contracts forward or settle in cash. They never ask for the metal. But what happens when they start asking? That's what's happening right now. In the last 18 months, physical delivery requests on the COMEX have spiked. Not by a little, by multiples. We're seeing contract holders stand for delivery in numbers the exchange hasn't seen in decades. And it's not just retail traders. It's sovereign wealth funds, it's central banks in Asia and the Middle East, it's family offices managing generational wealth. These are not speculators. These are entities that want the actual metal. And when they take delivery, that gold leaves the vault. It doesn't come back. It goes into allocated storage, into national reserves, into private vaults that are not part of the COMEX system, which means the registered inventory is shrinking, and the leverage ratio is growing. The COMEX is now operating at a leverage ratio that would terrify any traditional bank. But no one is talking about it, because the system is designed to hide this risk until it's too late. Now let's talk about silver. Silver is even more fragile. The silver market is smaller than gold. The inventories are thinner, and the industrial demand is far higher. Silver isn't just a monetary metal. It's used in solar panels, electronics, electric vehicles, defense systems, medical equipment. It's consumed, and once it's consumed, it doesn't come back into the supply chain. So unlike gold, where most of the metal ever mined still exists in some form, silver is being permanently removed from the market every single year. And yet, the paper market for silver is even more leveraged than gold. The ratio of paper silver to physical silver is estimated to be somewhere between 100 to 1 and 300 to 1. Let me say that again. For every ounce of physical silver that exists in the COMEX vaults, there are up to 300 ounces of paper silver being traded. This is not a market. This is a casino with no chips left in the vault, and the cracks are starting to show. In early 2021, a group of retail investors tried to squeeze the silver market. They bought physical silver and they bought call options on silver futures. The price spiked. The media called it a failed squeeze. They said silver came back down, the traders lost, the system held, but that's not what happened. What actually happened was the exchanges changed the rules. They raised margin requirements. They restricted trading. They made it harder to take physical delivery. And the price came back down not because the squeeze failed, but because the referees changed the game mid-match. But here's what didn't go away: the demand for physical silver. After that event, mints around the world reported record sales. Dealers couldn't keep inventory. Premiums on physical silver, the amount you pay above the spot price, exploded. And they haven't come back down. Right now, if you want to buy physical silver, you're paying $4 to $6 over spot. Sometimes more. That's a 20 to 30% premium. In a functioning market, that doesn't happen. In a functioning market, arbitrage would close that gap immediately. Someone would buy paper silver at spot, take delivery, and sell it at the premium. But that's not happening. Why? Because the paper market and the physical market are no longer connected. They're diverging. And that divergence is the break. Now add copper. Copper is the industrial bellwether. It's used in everything: construction, electronics, power grids, data centers, EVs. Copper demand is exploding because of the energy transition. Every wind turbine, every solar farm, every electric vehicle requires massive amounts of copper. The IEA estimates that copper demand will double by 2040. But here's the problem: copper supply is not doubling. In fact, it's barely growing. The largest copper mines in the world are aging. Ore grades are declining, new discoveries are rare, and it takes 10 to 15 years to bring a new copper mine online. So we have surging demand, flat supply, and a market that's priced based on futures contracts. And just like gold and silver, the copper market is starting to fracture. LME inventories, the London Metal Exchange, are at multi-year lows. Shanghai inventories are collapsing. And yet the price of copper isn't reflecting the scarcity. Why? Because the paper market is still in control. Banks and hedge funds are shorting copper futures, betting that demand will slow, that recession will hit, that China will collapse. But the physical market is telling a different story. Manufacturers are hoarding copper. Utilities are locking in supply years in advance. Countries are stockpiling. The gap between what the paper market thinks and what the physical market knows is widening every month. So what happens when the system breaks? Let's walk through it. First, the inventories run dry. The registered gold on the COMEX, the silver in the vaults, the copper in LME warehouses, they all drop to critically low levels. Second, delivery requests spike. More and more contract holders demand physical settlement. Third, the exchanges face a choice. They can either deliver the metal, which drains the vaults and exposes the leverage, or they can settle in cash, which breaks trust in the entire system. Fourth, if they settle in cash, the paper price becomes meaningless. Physical buyers stop looking at the COMEX price. They start negotiating privately. Premiums explode. The two-tier market becomes permanent. And fifth, once the paper market loses credibility, the pricing mechanism collapses. Producers stop hedging on the exchanges. Consumers stop trusting futures contracts. And the entire financial infrastructure that depends on commodity price stability starts to wobble. This isn't theory. We've seen it before. In the 1970s, the London gold pool collapsed. For years, central banks had been suppressing the price of gold by selling physical metal into the market whenever the price rose. They were trying to defend the $35 peg. But eventually, they ran out of gold. The system broke. And the price of gold went from $35 to over $800 in a decade. The same thing happened in the tin market in 1985. The International Tin Council tried to support tin prices by buying futures contracts, but they didn't have enough physical tin to back the trades. When the market turned, they defaulted. The LME suspended trading. The paper market froze, and it took years to rebuild trust. The difference now is scale. We're not talking about one commodity. We're talking about the entire commodity complex. Gold, silver, copper, platinum, palladium, nickel, cobalt, lithium. All of them are showing the same pattern: shrinking inventories, rising physical premiums, diverging paper and physical prices, and all of them are critical to the global economy. Now here's where it gets dangerous. The financial system is built on the assumption that commodity prices are stable and predictable. Banks use commodity futures to hedge currency risk. Pension funds use commodity indices for diversification. Insurance companies use commodity derivatives to balance their portfolios. And And all of this works as long as the paper market remains liquid and trusted. But if the paper market breaks, all of those hedges fail. All of those models break. And the risk that was supposed to be distributed across the system suddenly concentrates in a few key institutions. We've seen this movie before. In 2008, it was mortgage-backed securities. The paper said the assets were safe. The model said the risk was low, but the underlying collateral was garbage. And when the market tried to price the assets honestly, the entire system seized up. This time, it's not mortgages, it's commodities. And the collateral isn't houses, it's metal that doesn't exist. Let me show you the math. Let's say you're a bullion bank. You've sold 1,000 contracts of gold. That's 100,000 ounces. You're short, but you don't own the gold. You're assuming you can buy it in the market if you need to deliver. But what if everyone else is doing the same thing? What if there are 10 banks, all short 1,000 contracts each, all assuming they can cover in the market? That's 1 million ounces of synthetic short exposure, but the COMEX only has 20 million ounces of registered gold. So if just 5% of the open interest demands delivery, the entire system is underwater. And this isn't a hypothetical. This is the actual structure of the market right now. The leverage is hidden in the footnotes of exchange reports. The risk is dispersed across balance sheets. But it's there, and it's growing. Now, the natural question is, why hasn't this broken already? Why hasn't the COMEX defaulted? Why hasn't the LME frozen? The answer is because the system is being managed. The exchanges have tools. They can raise margin requirements, which makes it more expensive to hold contracts. They can limit position sizes, which prevents any single entity from cornering the market. They can change delivery rules, which makes it harder to take physical settlement. And in extreme cases, they can suspend trading altogether. All of these tools have been used before, and they'll be used again. But here's the problem. Every time the exchanges intervene, they erode trust. Every time they change the rules, they prove that the market isn't free. And every time they prioritize the paper system over physical delivery, they push more buyers into the physical market. So the interventions don't solve the problem. They accelerate it. And this is why almost no one sees it yet. Because the break isn't dramatic. It's not a single event. It's a slow motion unraveling. It's a widening spread between paper and physical. It's a quiet drain of inventory. It's a shift in behavior among the largest players in the market. Central banks aren't buying paper gold. They're repatriating physical gold. Sovereign wealth funds aren't trading futures. They're negotiating directly with miners. Family offices aren't trusting ETFs. They're buying allocated bars. And every time one of these entities exits the paper system, the leverage gets worse for everyone still in it. Now let's talk about who benefits from keeping this system alive. The bullion banks, the exchanges, the regulators, they all have an incentive to maintain the illusion that the paper market is functioning. Because the paper market allows price suppression. It allows banks to short commodities without owning them. It allows governments to manage inflation expectations. And it allows the financial system to avoid a repricing of hard assets that would destabilize debt markets, currency markets, and equity markets. So the break won't be announced. It won't be acknowledged. It will be denied, managed, and papered over for as long as possible, until it can't be. And here's the tell. Watch the premiums. When you see physical gold trading at a sustained premium to paper gold, that's the break. When you see silver dealers unable to source metal at any price, that's the break. When you see copper consumers bypassing the LME entirely and negotiating private contracts, that's the break. These are not theoretical signals. They're already happening, right now, in real time. The only question is how long the paper system can pretend it's still in control. Because here's the truth. The paper market was always a confidence game. It worked because everyone believed it worked. But confidence is fragile, and once it's lost, it doesn't come back. You can't rebuild trust in a system that has been proven to be a fractional reserve. You can't convince a central bank to trade their physical gold for a futures contract once they realize the contract might not be honored. And you can't force industrial users to rely on exchanges that have a history of changing the rules when the pressure gets too high. So the migration out of paper and into physical is one way. It's irreversible, and it's accelerating. Now, let me be clear. This isn't about predicting a specific price. This isn't about timing a crash. This is about understanding the structure of the market and recognizing that the structure is breaking. The paper market is not a price discovery mechanism anymore. It's a suppression mechanism. And suppression only works until the physical supply runs out. After that, the market reprices violently. And the people who were early, who understood the difference between paper and physical, who ignored the noise and focused on the fundamentals, they're the ones who are positioned correctly, not because they were lucky, but because they understood the math. And the math doesn't lie. The energy markets are showing the same pattern. Oil futures are traded in massive volume, but the physical oil market is tight. OPEC is cutting production. Strategic reserves are being drained. Refining capacity is shrinking. And yet the futures market keeps pricing in lower demand. Why? Because the models say recession is coming. Because the algorithms are programmed to short energy when bond yields rise. But the physical market doesn't care about models. It cares about barrels. And the barrels aren't there. So we're seeing backwardation in oil futures, where the near-term price is higher than the long-term price, which signals physical shortage. We're seeing diesel inventories at crisis levels. We're seeing natural gas prices in Europe decouple entirely from US prices because the infrastructure to move the gas doesn't exist. The paper market says energy is oversupplied. The physical market is screaming shortage. And eventually, the physical market wins. It always does. This is the part where most financial commentators would hedge. They'd say, well, maybe the system adapts. Maybe the exchanges fix the leverage. Maybe new supply comes online. But that's not how this works. The leverage can't be fixed without unwinding the positions. And unwinding the positions means either delivering metal that doesn't exist or defaulting on contracts. New supply can't come online fast enough. It takes years to build a mine. It takes decades to rebuild refining capacity. And the capital markets are not funding new commodity production. They're funding tech stocks and AI and crypto. The commodity sector has been starved of investment for over a decade. So the supply deficit is locked in. The only variable is how long the paper market can hide it. And here's the final piece, the dollar. The entire commodity paper market is denominated in dollars. Gold futures, oil futures, copper futures, all priced in dollars. And the dollar has been the global reserve currency for 80 years. But that system is also breaking. Not loudly, not officially, but it's breaking. Countries are settling trade in yuan, in rupees, in local currencies. Central banks are diversifying reserves away from treasuries and into gold. The petrodollar system, where oil was exclusively priced in dollars, is being quietly dismantled. And as the dollar loses its monopoly on commodity pricing, the paper markets lose their anchor. Because if you're China and you're buying oil from Saudi Arabia in yuan, why would you care about the NYMEX price? You wouldn't. You'd negotiate directly. And that's exactly what's happening. The largest commodity consumers in the world are bypassing the Western exchanges. They're building their own pricing systems. They're settling in physical, not paper. And every time that happens, the paper market loses relevance. So when I say the paper market is breaking, I don't mean it's going to collapse tomorrow. I mean it's becoming obsolete. It's losing its function. And markets that lose their function don't disappear overnight. They fade. They become irrelevant. They become a place where only the uninformed still trade. And the gap between the paper price and the physical price becomes the gap between the official narrative and reality. Now, what does this mean for you? It means the price you see on a screen is not the price you'll pay in the real world. It means the commodities that the financial system says are abundant are actually scarce. It means the hedges that institutions think they have don't exist. And it means the repricing, when it comes, will be violent, disorderly, and impossible to front run if you're still trusting the paper market. The people who understand this aren't waiting for confirmation. They're not waiting for the media to explain it. They're not waiting for the exchanges to admit it. They're acting now. They're moving out of paper and into physical. They're securing supply. They're locking in prices because they know that once the break is obvious, it's too late. The system will fight this. The exchanges will adjust rules. The regulators will issue statements. The media will call it a conspiracy theory. And the banks will short the rallies, trying to defend the paper price. But physics doesn't negotiate. You can't print gold. You can't create copper out of nothing. You can't legislate silver into existence. And you can't force someone to accept a piece of paper when they wanted the metal. The laws of supply and demand are not suspended just because a market is financialized. They're just delayed. And the longer the delay, the more violent the adjustment. So here's where we are. The inventories are draining. The leverage is expanding. The premiums are widening. The physical buyers are bypassing the exchanges. and the paper market is pretending everything is fine. But the break is already